Welcome back to an unconventional approach to financial self-reliance. In this session, we're going to be talking about mortgages and the way that we are manipulated by mortgage companies. One of the things that I've enjoyed through the years is watching Magician, but as I gotten older, I realized that it's really not magic. It's a matter of illusion. The way that magicians work is based on distraction and then manipulation. They distract us from what's really going on, a colorful handkerchief or a wave of the hand, and while they're doing that, they're manipulating the coin so that in the end it makes it appear as though the coin is disappearing, and it is in fact disappearing in our mind. Mortgage companies and other financial institutions operate in much the same way. That is to say that they create a distraction and then they manipulate us, and then our money disappears into their coffers, if you will. Let me give you an example of what I mean by this. This is a typical mortgage situation. I've just used some sample figures here. We got a $150,000 loan, 6% interest rate for a term of 30 years. Now, in the first year, what I want to point out to you is that the payment, which is $900, consists of $750 of interest and $150 of principal. Well, now what that really means is that the amount of interest that we're paying as it relates to the payment is 84%. So the distraction here is the interest rate. You see, mortgage companies use interest rates primarily, and they talk about other things, service and fees and other things, but primarily the interest rate is the thing that everybody talks about. That is a distraction, because the reality is that the 84% is not anywhere near 6%. Now let's move on with this example. I'll show you a few more interesting points here. At the end of 5 years, we're still paying 78% of every payment toward interest. Let's hop down to halfway point. 59% after 15 years. The payment at the end of the 15th year is still 59% of the total payment. Excuse me, the interest is 59% of the total payment. And the average interest over the full 30 years, in other words, if I took that right-hand column and I averaged out every time what the number was, it would be 54% on average of every payment that we make is going to interest. Now, I'll make an interesting side note here. It's not until the 29th year that we actually make a payment that is 6%, that the interest is 6% of the payment. So over a full 30-year period of time, we'll pay $174,000 on this mortgage. Well, let's come back up here to the first 5 years worth of payments, because the typical family in America moves every less than every 5 years, or they refinance every 5 years. So typically we don't have a mortgage for more than 5 years. What that means is that we're always paying interest at the highest possible point. Somewhere in the neighborhood of 80% of our money is going to interest. Just one more little note, that we pay $43,000 of interest in that first 5 years based on these terms. Well, that's just one of the manipulations. Here's another one. Everybody knows that you've got a mortgage payment that has a due date, and then there's a grace period. And at the end of the grace period, there is a late date, which is typically the 16th. And so we're very careful about knowing to use that grace period. The distraction, though, is in fact the point. There is a late fee, a big, ugly, looming late fee, $75 or 5% or $100, whatever it may be, but it's something that we absolutely want to avoid if at all possible. As a result of that, when do most people make their payment? As close to the end of the grace period as they possibly can. They want to take advantage of that grace period. Well, the grace period really isn't a grace period. That's a little bit of a misnomer, because here's the manipulation. Interest continues to accrue between the first of the month, or in other words, the due date, and the date that the payment is actually posted. What does that mean? It means that even though we're avoiding that big, ugly late fee, we're still paying the bank extra money. The amortization schedule that you get when you get your mortgage is only accurate so long as the payments are posted on the due date according to the schedule. In this case, we're saying it's the 1st. As soon as you don't have that payment posted on that date, you are no longer, that schedule is no longer accurate. How bad is this problem? Well, I hope this won't really hurt you too bad, but according to the Government Accounting Office, over $5 billion a year are paid by Americans on their mortgage in the interest that accrues between the 1st and the 16th. That's not the regular interest. That's the interest that accrues only between the 1st and the 16th. It's a staggering amount. So how do you handle this? Well, we'll show you how to do that in a later session. Now, for some of our families, the situation of manipulation has gotten so bad that we're actually in jeopardy of losing our homes. And so for hardship cases, we have a process that we can take homeowners. There's a Hope for Homeowners, and it helps them to get to keep in their homes with affordable payments. Now, if you have questions or would like to know more about some of the strategies that we use in the unconventional approach to financial self-reliance, I'm providing my contact information here.